Hey everybody, welcome to the morning market briefing. It's Wednesday, September 7th, 2022. Hope you're doing well. Futures down just a little bit. NASDAQ futures down about 0.25%, S&P and Dow futures hovering right in that range as well. So just a little bit red, not anything too daunting, but something to keep an eye on. As we jump in today, let's start with some economic data. We got the ISM services report yesterday. The headline reading came in at 56.9. Uptick from 56.7. Employment came in a little better than the last reading. Prices down ever so slightly, although I wouldn't say to a meaningful extent. Ben, what commentary stood out? What were some of the things that you think are key takeaways?
Yeah, I was pleased by this data. It does seem to be congruent with other data that we've seen out of August in terms of the consumer feeling a little bit better about life. Whether that is warranted or not will remain to be seen. I think a lot of those rent increases that get pushed through in the summer and a lot of the gas prices, I think a lot of those have kind of faded to the background at this point, which I think is helping sentiment just a bit. But again, I don't think that really solves the issue of inflation, of core inflation going longer term. And I think that the Fed is going to be very attuned to that. Already today, we've already had a Wall Street Journal article from Nick Timiraos, who really has Jay Powell's is Jay Powell's congruent to the market, conduit to the market, essentially informing the market that there's going to be a 75 basis point raise on September 21st when they meet. And we'll talk a little bit about that here in a minute. In terms of the actual economic data, some of the comments that we saw from the ISM report yesterday suggested that there was an improvement in lead times and prices within the construction industry, and that there's some cost pressure release on accommodation and food services. Probably the most notable piece that I like to look at is on retail. And there they said that there's no major changes. There are some concerns about the macroeconomic climate and consumer confidence, but there aren't any changes, which is similar to what we saw from Visa and Microsoft and a lot of these other companies who have been reporting at conferences in the past week and will continue to report at conferences over the next week and a half.
More globally, we'll come back to rates here in just a second. The yen continues to get blasted. Now at 144. A year ago, it was at 110. The euro and the British pound are similar. We've talked a lot about that and just kind of the strengthening of the dollar on a relative basis. But let's talk a little bit about what we're seeing with rates, Tom. Pretty decent bond sell-off. The 10-year now at 3.3. Mortgages really rocketing up. What data do you think people are anticipating? What are they looking at that's really driving this?
I mean, it's almost everything, honestly. The big one yesterday, I think, was really coming off the heels of all of the, essentially backdoor stimulus we're getting in the UK and Europe to fight. They're fighting inflation with what is essentially monetary easing. I mean, they're giving, creating functional stimulus by, putting all kinds of measures in place to limit the cost of energy. And that really sent rates up in Europe. And, we're basically, as we always talk about, very tethered to those rates. And so it kind of came unglued yesterday. We had a really, really big push up in the 10-year, as well as the 2 and 30 years. We've hit a new high on the 30-year for the year. The 10-year is still not hit a new high going back to all the way back to May, but we're very close. Topped out at 347. I believe we're about 330 right now. And so, rates are moving up and they're going to continue to move up. That being said, I think we're in a similar position where doom and gloom is kind of at max effect right now, particularly in the bond market. And so I think it's a really good opportunity in the same way that, we said 3-4 weeks ago, it wasn't a great time to buy bonds. Things have really rallied. And the narrative was that the Fed was going to pivot and not raise rates. It didn't make any sense at the time, and it still doesn't make sense retrospectively, especially now that we know for sure we're probably going to get a triple rate hike. I mean, at this point, it's an 80.7% chance we'll get the triple hike here in 2 weeks. So I think this is a really good opportunity. I think things are a little oversold. I mean, if you look at mortgage rates at 6.25%, I mean, that's a really, really high rate. It's going to really put some pressure on the housing market, which I think is going to slow demand, which is essentially going to bring inflation down to a certain extent, which means that the next print might be unexpectedly low, which, could potentially reroute this whole bond situation very quickly. So that's where we're at. It's kind of hard to navigate this environment right now, but I think that the longer these rates stay up, the better opportunity we have in a lock in for a long time on some really nice tax-free stuff. And I think that it's going to turn back the other direction. How quickly that happens is kind of tough to say.
On the equity side, I think we're seeing something similar, at least in the very short term, in terms of the equity market. I think wants to rally right now. I think but every day you come in, the market tries to rally. I mean, the futures were up this morning. And then they have sold off after more concern about Europe, what this gas price, natural gas ceiling is going to do to the overall economy there. But essentially, you've seen every single day market wants to rally. Friday, the market was up, and then you had Russia come in and stop gas. Yesterday, the market was trying to rally, and then you had bonds just fall off a cliff because primarily due to Europe. So as long as these, I don't want to call them exogenous events, but certainly outside of the U.S. locus of control are taking place, while companies in the United States are actually saying things have stabilized over the last couple of months, I think that's a little bit of a window to build positions in companies that can withstand a recession, and we can use that weakness to our advantage. Now, are we going to buy the high beta names, the ones that are overtly exposed to a recession or are overtly exposed to weakness in China or Europe? No, we're going to stay away from those, just as we have been over the last 6 months. But I do think that keeping allocations tight and using these weakness to purchase stocks of good businesses that can withstand a recession, I think is a wise thing to do.
Yes. Sorry, as you say, the big takeaway is that if you look around, every first world country is getting crushed right now, and we're really not. I mean, the dollar is strengthening every day while everything else is falling off. I think that's an indicator that while things are bad globally, the U.S. is in a good spot relatively, but if we are losing value on the equities, it is an unbelievable opportunity. And same with the bonds.
Yeah, and I think that's been a big part of the focal point kind of behind the curtain of what we've been working on in the investment committee meeting. The last 2 meetings, we've really focused on 2 topics that I think were helpful, really trying to identify businesses that we think will be in a better position 1 year from now. And secondly, really taking a look at, hey, are there companies that we have in the portfolio where maybe conviction is waning given what we're seeing economically? And even as we were having yesterday's investment committee meeting, which we do, usually Tuesdays and Fridays at 10:30, even in that, Ben, I thought you saw the market trying to rally. Like, we opened up around 0.5%, fell off pretty quickly, down 0.5%, and really bounced back and forth for the better part of the morning, kind of between that up 25 basis points and down 25 basis points. There was a real concerted effort there. It seemed like just not quite enough juice to actually turn into that positive territory. So I think there are opportunities. I think putting a premium on solid businesses that are going to be able to weather what is sure to be, if you've listened to these calls, some challenging economic conditions. I think that's really the key.
And to be clear, yeah, we do still see some, these challenging economic conditions, but I think that it's never fully one side, never fully the other side. Yeah. And I think there's some nuance there, but I don't think that's really changing.
And I'm somewhat encouraged. We didn't talk about this at length, and certainly haven't talked about it on the call. I'm somewhat encouraged that we are in a period, although there's heightened volatility, we are in a period in which we are seeing dispersion, even among blue chip stocks, even within sectors, of some companies being up more than others, some down more than others. This is an opportunity where if you can find an attractive thesis and an attractive valuation, attractive valuation, there are opportunities. This is not a period in which, market's down 0.5%, everything's down 0.5%. There are pockets there. Samsung has warned that the chip industry is going to further deteriorate. For what it's worth, the World Semiconductor Industry Group expected 2022 chip revenue to be up 16%. Really looking more up 13 to 14%. In 2023, the expectation was for growth of 5%, really looking in that mid 4% range. The head of Samsung Semiconductor Unit, Hyun, said that the second half of this year looks bad, and as of now, next year doesn't really seem to show a clear momentum for much improvement. I don't think anybody's necessarily surprised by that commentary. And even if you look at the expectations for 2022 and 2023 chip revenue, the slowdown was anticipated. It's just potentially slowing down from a lower base.
And it's tough to know how much of that is units and how much of that is pricing too. And then of course you have the volatility within semiconductors. Is it used for industrial use? Is it used for consumer use? Is it used for data center? Is it used for communication? Which sector is it actually dependent upon? But I think that's a fair view from Samsung, and I wouldn't disagree with it.
Apple event, I'm just going to kind of run through all the things that everybody's looking for. Big thing is iPhone pricing. Goldman Sachs, for what it's worth, does not expect higher prices in the US relative to last year's version. There will be some foreign currency prices to account for. There is a question as to whether this will be purchasable as a subscription. Obviously, anytime a new iPhone comes out, people are looking at the features. The Pro model may include satellite capabilities for off-grid locations. This would also create potentially an opportunity for a satellite subscription plan. We are watching pretty closely, I guess, a juiced up Apple Watch, something that's going to be in the $900 to $1,000 price point, something that would compete with Garmin watches and other higher end wearable tech. So that's something to keep an eye on. Airpods Pro 2 could be an upgrade from the Airpods Pro, which last came out in October of 2019. People are looking for upgraded wireless and audio chips. And then there's just kind of a bevy of other topics that people are curious to see if it's addressed. Will they mention anything along the lines of the Apple Car, which has long been rumored? Will they mention any VR products, something that might compete with Oculus? Will they mention software? Obviously, there's been an upgrade to the iOS on the phone as well as the watch that came through in June, but sometimes you get a little bit of a hint based on the hardware of what may be in the pipeline. Guys, as you think through this, obviously it's a big event. It's always streamed on a bunch of different platforms. It will be highly discussed. How do you kind of define the impact of an event like this for a company as big as Apple?
I mean, I think for this one is they really need to show some sort of improvement in the iPhone. I think it's been a couple of years since we've seen a massive change. I think the new watch is going to be exceptional. They've sort of had a little bit of a Garmin moving in on their block. You know, the Garmin watches are very hot right now, and Apple doesn't really have something at that same level to compete with it. The AR VR obviously could be huge. They could really continue to just give Meta a massive noogie. You know, they basically shut them off on the phones and really hurt their ad biz, and now they can basically go for their new big venture, the Oculus. You know, they could just give them another big noogie, and who knows where that leaves Meta after that. So I think it could be interesting. The car, I mean, I don't even know where to go on the car. Is it a thing? Is it not a thing? It's kind of been floating around the ether for years, but it can be massive if it's a real thing.
Ben, how do you kind of digest this? How big of an event is this actually?
I think the Apple Watch could give some nice upside to the quarter and to the near-term quarters, because I do think that the software upgrades right now are fairly good, and importantly, Apple models 1, 2, and 3 will not be supported with the new software. So I think that will start to create some sort of replenishment demand for the Apple Watch, and I think that already the software features that are going to be embedded in that are going to be able to better compete with Garmin. The iPhone, I think, will continue to perform well. I think the big question mark is China. What's the uptake there? I think that they'll also announce an earlier launch in India, which should help. Although, again, we'll have to see how much elasticity happens as they raise prices in international geographies.
Awesome. A lot of conferences popping off today and tomorrow, really throughout the week. Companies speaking at kind of these more corporate events usually is a good opportunity to lay out vision as well as guidance. At the Barclays conference, we'll hear from Union Pacific, NextEra, Constellation Brands, Archer Daniels Midland. Citi has a conference going on at the same time. Texas Instruments will be speaking. Microsoft, Eli Lilly. Bank of America has a conference going. You'll hear from Disney, AT&T. Evercore has a conference going on. ADI will be talking there, as well as Intel and others. Just potentially a busy day on the news front. Ben, outside of just raw guidance and kind of outlook, is there anything in particular you're looking for, or any of these companies you're most excited to hear from?
I think the theme is going to be steady as she goes, which will actually be a positive for a lot of these companies. I'm especially interested to hear what's going on the tech world, although I think we have a decent handle on that. I think anything consumer related too will be interesting. I think AT&T could perhaps have one of the more significant calls, because in their last earnings call, they complained about customers not paying their bills. So are they going to start paying their bills again? That was one of the first areas that we were seeing where you were essentially seeing pseudo defaults, not defaulting on loans per se, but not paying their bills as expected.
Good stuff. Good stuff. We're going to wrap it up there. We will be back tomorrow. I'm sure we'll have some takeaways from that commentary that we'll get from management team. But outside of that, hope you guys have a great day, and we'll talk to you soon.